Hello, good morning, good afternoon, and good evening. Thank you for joining us today. Hopefully many of you joined us yesterday for the IAIS Town Hall. If not, a recording of the day will be available soon on our website. Today we have two great panels lined up. We will start with a panel on embedding climate risk management in the insurance sector, which is a key strategic focus for the International Association of Insurance Supervisors. The panel will be moderated by Geoff Summerhayes, an ExCo member of the Executive Board of the Australian Prudential Regulatory Authority, and who is a passionate sponsor of our climate risk work. We'll then have an excellent panel on addressing the insurance protection gap. This is also a key focus for the IAIS, as it takes action to ensure the development of resilient insurance markets. The panel will be moderated by Gabriele Bernardino, an IAIS ExCo member and chairman of the European Insurance and Occupational Pensions Authority. All audience members throughout will be muted. However, you can ask the panelists questions using the question function. They won't appear on the screen, but they will be shown to the moderator and the panelists. We have over 570 people on the line today, which is a great turnout, and I look forward to the discussions. With that, over to you, Geoff.
Thanks, Connor, and I would also like to add my welcome to all those that have joined the call today. So good morning to you, good afternoon, or as the case is here in Australia, good evening. It's great to be with you and have an opportunity to moderate this important panel on embedding climate risk management in the insurance sector. Climate change is increasingly recognised as an overarching global threat, with a wide range of impacts and implications for the structure and the function of the global economy and hence the financial system. As a result, there is growing financial risk for the resilience of all firms, including insurers. There is not only risk, but also opportunity with the transition to a low carbon future, and also the green recovery initiatives that are now underway as a result of the pandemic. Climate financial risk is a key initiative, as you've just heard from Connor, for the IAIS. As many of you would know, the IAIS, in partnership with the UN-convened Sustainable Insurance Forum, recently released for consultation an application paper on the supervision of climate risk in the insurance sector. This is a significant step because we are the first standard-setting body to issue such guidance. The application paper follows two earlier information papers on the implications of climate risk for supervisors, published in 2018, and a second information paper which was published earlier this year on the insurance sector's adoption of TCFD. The application paper outlines supervisory guidance in 5 key areas: ICP 9 supervisory review, ICP 7 on corporate governance, ICP 8 and 16 on risk management, ICP 15 on investments, and ICP 20 on disclosure. 3 of these areas, corporate governance, risk management, and disclosure, will be the focus of today's panel. So let me introduce our great panel to you. Aylin Coqui is the Chief Risk Officer globally for the Allianz Group, and we wish her a warm welcome. Olaf Sleijpen is the Executive Director for the Dutch Central Bank, the DNB, and Ray Farmer is the President of the National Association of Insurance Commissioners in North America and is also the Commissioner for South Carolina. So welcome to Aylin, Olaf, and Ray. Can I start with moving to the role of corporate governance? In the application paper that has been published, in section 3 of the paper, this section looks at the oversight of management responsibilities, business objectives and strategies, the role of the board, and the duties related to risk management, internal controls, as well as remuneration, through a climate lens with each of those responsibilities. So can I start with you, Aylin, as a global insurer and certainly a leader in this field? What have been some of the challenges for Allianz in thinking about governance as it relates to climate financial risk?
I think overall, in terms of our governance, certainly we represent environmental and sustainable governance board as our kind of top governing body for the sustainable related issues. Given the fact that we are a multi-line insurer in many countries in a relatively complex environment, obviously the overall coordination and governance becomes a little bit challenging. And this is why it becomes extremely important to have this ESG board at the highest board level, which is what we have. We have 4 board of management members in this board, as well as myself, and representatives from all the different functions, both in terms of sustainability office, communication, but also key function holders like myself and compliance, etc. So I think that's really important to have that. And then this body, which actually has 40% of the board members in it, is acting as an advisor to the board itself in terms of all the key decisions and all the activities that we are taking in the climate space. Now, in terms of the challenge, one challenge is, well, how do you really integrate that into the inner workings of the organization? And we have recently set up cross-functional ESG task forces, I call it, like 10 of them. And these are in integration of climate risk in underwriting, into investments, environmental management, societal impact, regulation, lobbying, climate risk disclosures, overall operating entity collaboration. So all of these are having both local as well as group function and experts to really drive these topics forward. And we have the climate integration team, I think that's quite important, who is really working on early identification, measurement, and business integration of risks, as well as the opportunities arising from the climate change and low carbon transition. Now, we have integrated this quite effectively into our 3 lines of defense, both to the business, to the second line, and the third line. But I should also say that it is a challenge because this is a very evolving topic. It has short-term and very much longer-term implications with the physical risks, the chronic risk, acute risk, and the transitional risk that are coming out of it. Therefore, I call this a living animal. You know, it's a governance that will evolve, and it gets more and more integrated into also the incentive structure that we are having. And what we also find important is to really ensure that the underwriting and the investment experts are also talking to each other from NatCat and investment perspectives, because if the silo approach really leaves a lot of know-how kind of untouched. So that's one area where we are really ensuring that the underwriting know-how, for example, gets into evaluation of the investment know-how from a climate risk perspective. So that's kind of a little bit long answer, but that's how we are kind of set up. Sorry.
Can I ask a quick follow-up question? That sounds very extensive. But what has been the driver of that? Is that response to regulation? Is it response to is it a response to investor concerns, to customers? I mean, what has driven that quite extensive response that you've outlined?
Well, I mean, it's a combination of quite a few things. I mean, we are also looking at all the emerging risks. So it's I think it's no surprise or no secret that there's potentially even tsunami coming our way, and as Angela Merkel put it, it's 5 minutes after 12. So I think the sense of urgency is definitely here. But from a regulatory perspective, from a customer perspective, when we look at all the stakeholders that we have, I think this urgency is also increasing. And importantly, yes, we will come to that probably. There's a lot of harmonization that needs to be done, but we don't want to lose momentum, and we don't want to be behind the curve. We want to be able to have as much impact as possible, as early as possible. That's kind of what's driving it.
Thank you, Aylin. Ray, can I come to you? What specific requirements does the NAIC have for US firms as it relates to governance on climate risk?
Thanks, Geoff, for the question. And before I answer that, I don't want to miss the opportunity to I know you're at the end of your term, in your current position, but I don't want to miss the opportunity to thank you for what you've done for the SIF or at IAIS. You are a true champion of sustainability, a true environmental champion. And so I wish you well. And on behalf of the NAIC, thank you for all of your efforts. And we wish you well going forward. So, but as to the question itself, while there are currently no explicit governance requirements related to specifically to climate in the U.S., we do investigate the governance and oversight of climate risk during our solvency monitoring process. For example, climate risk may be discussed and disclosed in the ORSA filings, the corporate governance annual disclosure, and through the climate risk disclosure survey that a number of states require to be completed on an annual basis. In addition, an important element of our on-site corporate governance review is interviews of the executives that are conducted during each examination. During these interviews, we ask questions regarding the governance of key risk exposures, including those related to climate change. In fact, Geoff, there are specific questions related to climate change included in our interview questions for the Chief Investment Officer and the Chief Risk Officer.
Thank you, Ray. We'll come back and explore a bit more of that in a moment, I think. Olaf, can I come to you? How about for the DNB, what specific requirements do you have from a governance perspective of firms?
Thank you, Geoff, for the question. But before I answer it, I also would like to express my gratitude for the work that you've done for the IAIS, but for the SIF in particular. And we met several times in that context, and it was always a great pleasure. And I hope to see you again in the context of sustainability. On your question, actually, maybe to set the scene a little bit, in the Netherlands, we do fit and proper testing of board members, supervisory board members, and we do it ex ante, so it's not ex post. So before board members or supervisory board members can be appointed, they should actually go through us, so to speak. And from next year onwards, we will take into account their knowledge of, let's say, climate risk in relationship to the insurance company. Of course, we will take that into account. That's going to be proportional, obviously. It depends on the size of the insurance company, the type of the insurance company. It may be more important for, let's say, somebody like Aylin than for somebody else at maybe an insurance company where it might not matter that much. But we definitely are going to look at it. And we also, because sometimes we also do interviews, we will also, let's say, put those issues on the table when we interview people who are nominated for board positions. What we also do. Can I
ask you on that? Are you going to issue guidance on that? So how does a prospective director know what good looks like? Yeah,
I mean, in general terms, we have already done this. So this is not new, let's say, to the sector. But of course, what we don't do, and we don't do that with all kind of expertise. We don't actually issue exactly like this is what you need to know when you have this kind of function. It's very case specific. And it's not like learning a book by heart. That's not the point. But what the things we are in general terms, the things that we want to know, that we expect people to know about this particular risk, is something that we have communicated already to the sector.
Thank you, Olaf. So let's move to to risk management, because I'm keen to actually spend a fair chunk of our time on disclosure, which is a very hot topic. But I want to address risk management next. In section 4 of the application paper, risk management and internal controls are outlined in terms of the supervisory guidance, and it sets out requirements on systems, risk management and internal controls, including control functions. And this section provides guidance on how supervisors could integrate climate-related risks into their supervisory expectations around risk management and other such functions. Staying with you, Olaf, do I understand that you are considering sort of some quantitative requirements as it relates to risk management and scenario analysis with firms? Perhaps you could explain some of that.
Yes. First of all, what we've done actually already last year is issue a good practice to the industry about what we expect the industry in terms of analyzing climate risks and also coming up with measures to mitigate those risks in the context of the ORSA, as Ray already just pointed out. We actually do the same. And we already analyzed, let's say, a first batch of ORSAs, and about half of the insurance companies actually mentioned climate risk as a substantial risk. That was also kind of, and then it was also kind of elaborated further on in the ORSA. It's also kind of interesting to see that most insurance companies, they see climate risk mostly on the liability side, which is obvious in certain businesses. But sometimes they forget that it might also be an issue on the asset side of the balance sheet, depending on your asset mix. That's something that even where we would say you might have a risk in that particular field, they don't always see it. So I think a lot needs to be done here. But as I said, it was the first wave, basically, of ORSAs. Of course, we operate within the European Union context, and EIOPA has recently issued an opinion on actually the use of scenarios that insurance companies should use in this respect. And basically, one scenario is, what if measures to counteract climate change are not going to work? So basically a 2% plus scenario, because then all kind of risks will definitely materialize, like physical risks. It may have a huge impact on your portfolio, obviously, but also the other side. So what if measures are effective, or measures are being taken that keep the increase in temperature below the 2%? Because in that case, indeed, the transition risks play an important role, and they already do. I mean, you only have to read the newspapers to see the depreciation of oil and gas reserves. That's already taking place, partially because of the low oil price, obviously, but also to some extent because of let's say, the climate change risks. So that's basically, so what we are doing in this area very much will build, first of all, very much on what EIOPA is doing, and we are also, of course, contributing to the work of EIOPA quite extensively.
Thank you, Olaf. Aylin, I'll come to you. Allianz is a huge global firm. You operate in lots of different markets. How do you get consistency on say, some of the issues that Oliver's just referenced there in terms of modelling and other requirements?
Now, actually, modeling, this is a challenging area, I should really say. Let me first say a little bit our approach, and then I can talk a little bit about the challenges. We do rely on publicly reported data and ideally audited climate-related data where possible. So we want to start with the facts. We're also developing our own approaches, like AI approaches too, to source the climate-related data on our own. But what's important is, I think, really analyzing the fundamental drivers of climate change instead of the pure detailed quantification. For example, how do certain clearly observable trends, like transition from coal to renewables, petrol to electric, is really affecting our business? How do we respond strategically? We are also developing our own approaches to quantify the climate change risks and opportunities, kind of building in-house capacities. For example, it starts with simpler models, and then we enhance these models as we have more scientific insights and our experience evolves. For example, we have had advances in climate modeling combined with very high resolution hazard maps that we developed within our reinsurance business and R&D, so we could really quantify implications of in climate change in Germany, for example, for our flood exposure. So it's so that really helps us to kind of further then integrate more perils, and more geographies in addition to that. And then, for example, for our investment management and group risk, we have did this together. We have emission price stress test models for listed equity and corporate bonds, so on the asset side of the balance sheet. So it leverages on our existing infrastructure on carbon footprint reporting, and it's a relatively simplistic model, but it really allows to generate insights regarding impacts of short to medium term emission reduction, policy changes, etc. So these are kind of how we are approaching it. But it is challenging because the third-party models are, there's the data quality is not necessarily good, and also you have different sources with different data levels, so it's the inconsistencies, and I think that kind of makes it difficult to really rely on the third-party model providers. So I think that's but I'm confident that's something that will evolve and develop as science develops.
So, Aylin, there is a lot of supervisors on this call, no doubt, and you sound like there's a lot of sophistication in the group office from Allianz perspective in Munich. But what should be my expectations sitting here in Sydney about Allianz in Australia or any of the other supervisors on this call? I mean, how do you see the consistency across the group in terms of rolling out that capability? And I guess that plays to some of the proportionality issues that Olaf was referring to with the larger firms and the smaller firms. I mean, how do you think about that as a group?
For us, in terms of, for example, our geocoding, this obviously starts with more material, larger OEs. We are also operating entities, what OEs means. And we are trying to extend it as much as possible because the overall models can be utilized globally. The issue, I think, is in terms of reporting requirements, different jurisdictions have different requirements, also expectations. Now, I think obviously our hope is that we would welcome efforts by standard-setting bodies like IAIS to harmonize risk management guidelines, in collaboration with the sector, to really kind of get to more of a standardization, harmonization. But at the same time, you cannot just wait for this to kind of evolve your model. So I think it would be in the best interest of everybody to continue to evolve the models and ensure that we are getting more and more grip on climate change risks into multiple perils and multiple locations. And that's kind of what we are trying to build upon, while in parallel hoping and supporting this harmonization and standardization of reporting, stress testing, as well as disclosures.
Thank you. Ray, in the US, there is a requirement to report all relevant and material risks in the ORSA, as you have said. How do you think the sophistication and evolution of climate risk as it relates to the ORSA is progressing across US firms? Perhaps give us a view from what you see with some of the larger firms to the mid-sized and smaller firms, and from a NAIC point of view, is that where you want it to be?
Sure. Let me first follow up on something that Olaf was discussing. At the NAIC, we've developed a climate resiliency task force, and one of the work streams on that will be including developing climate risk stress tests and scenario analyses to evaluate potential exposures to both the physical and transition impacts of climate change. So if multiple jurisdictions are doing similar work on scenario analysis, this could be an area where sharing of experiences and good practices would be a benefit to insurance supervisors around the globe. So on the ORSA piece, U.S. ORSA requirements as described in our NAIC guidance manual require insurers to explain how they identify, how they assess, monitor, prioritize, and report all material and relevant risk. To the extent that an insurer deems climate-related risk material to its business strategy and questions, these risks should be disclosed in the annual ORSA summary report filed to the supervisor. The determination as to whether climate-related risk or material, it's made in the first instance by the insurer and later reviewed by the supervisor. The supervisor certainly has the authority to require the insurer to incorporate climate-related risk in its ORSA and or require changes in assumptions and scenarios utilized by the insurer in this area.
Ray, can I ask a cheeky question and ask, how often do supervisors say to firms that actually we don't think that you are where you need to be as it relates to climate risk? I mean, how often do you overrule the firm as it relates to what they're disclosing in the ORSA around climate risk?
Well, obviously, each individual company is separate. So looking at each company, it certainly happens, from time to time that we'll say not only on climate-related risk, but other risks, you need to be including this and paying attention to this area. So it certainly happens on a regular basis.
Thank you. I want to move to disclosure if we can, because this is a hot issue, and I think it's probably in the TCFD framework. Certainly larger, more sophisticated firms have made great progress around strategy, governance, and risk management, but the issues on disclosure have been more challenging, and there are a whole pile of good reasons for that: taxonomy, standardized approaches, standard scenarios, stress tests, modelling capability, as you've heard from our panelists. And we also found in the information paper that the IAIS and the SIF published earlier this year that while 75% of firms by number, there were some 1,300 firms in the survey, said that climate was material to their business, only about 24% of firms were actually taking action to address that issue. Certainly the larger, more sophisticated firms were doing that, but there was a long tail of firms that it was more difficult to see progress on the issues. So I think this is a good area to spend a fair chunk of time on. So in the application paper, section 7, ICP 20 requires firms to disclose relevant and comprehensive information in a timely manner in order to give policyholders and market participants a clear view of their business activities, risks, performance, and financial position, which therefore enhances market discipline. And so in the application paper, as indeed the issues paper, it's mapping climate risk back into ICP 20 and those requirements. So Ray, staying with you on disclosure, the NAIC does have a disclosure regime in place for insurers, as I understand it. So what sort of information is, and that's been going for some time, as I understand it. So I think even before the TCFD came out. So what sort of information are firms asked to disclose in that? It's an annual survey that you run, is that correct?
Yes, Geoff, the Climate Risk Disclosure Survey was adopted by the NAIC in 2010. Currently, the survey is being administered in a multi-state initiative that includes 6 states, briefly California, Connecticut, Minnesota, New York, New Mexico, and Washington State. My memory is working this morning. The survey has 8 questions. Ask insurers to provide a description of how they incorporate climate risk into their mitigation, risk management, investment, business plans, and identify steps that taken to engage key constituencies and policyholders on the topic of climate risk. Responses are collected annually from non-life or property casualty companies, life and health insurance companies in the 6 participating states with direct written premiums over $100 million. This equates to about 1,200 individual insurers representing over 70% of the U.S. direct written premium. Annual responses are then organized into a publicly accessible database located on the California Department of Insurance website. So for the reporting year of 2019, NAIC Climate Risk Disclosure Survey due from insurers this past August. Participating insurers were allowed to submit a TCFD report in lieu of the NAIC Climate Disclosure Survey. So 8 groups and 8 individual insurers submitted a TCFD report in the reporting year for 2019. But insurance companies are increasingly moving toward climate disclosures that are consistent across financial institutions. Given a global shift toward adopting TCFD guidelines, the NAIC Climate Resiliency Task Force that I briefly mentioned earlier is considering appropriate climate risk disclosures within the insurance sector and may decide to explore further aligning the NAIC climate survey with the TCFD in the coming years. For example, although the current survey is a series of yes/no questions, there is a substantial narrative accompanied with each response, and it's onerous for supervisors to interpret those results. So there are modifications to be considered that could help with the TCFD alignment and promote uniformity in reporting requirements. Additionally, later today, in about 8 or 9 hours or so, this task force is going to meet and hear from 2 organizations, the American Academy of Actuaries and the NAIC's Center for Insurance Policy and Research, regarding separate research projects to evaluate the NAIC climate risk disclosure data. Relatedly, the NAIC recently released on its website findings from its first analysis of the 2018 Climate Risk Disclosure Survey. The analysis found that reported engagement with climate risk mitigation activities is up. But, as always, there's certainly more room for improvement across the industry. That was a little bit longer answer than you probably wanted, Geoff, but that's where we are.
It's a very thorough answer, Ray, so thank you. I appreciate that. Olaf, back to you. The big debate is around regulatory nudge, or should it be mandatory? A number of jurisdictions globally have already announced mandatory disclosure in line with TCFD. The UK, the Swiss for larger firms down in my part of the world, our friends across the Tasman, the Kiwis, the New Zealanders have announced this, and a lot of that's happening quite soon. What's the position in the Netherlands on disclosure and the notion of mandatory or otherwise?
I would say I think it's very important that we move forward with this. To answer your question directly, it's not mandatory yet in the Netherlands, but I think it should. And not only in the Netherlands, I think we need to embark on truly a global initiative here, and also to come to some kind of harmonization of reporting requirements. What we see now is that in particular the larger insurance companies, they're clearly ahead of the smaller ones, but they're all developing their own methodologies. Not completely true. in the sense that they all talk to each other, and there are a lot of, let's say, market or consultants and providers of these kind of services that help as well. But in general, yeah, it's up to them. But this is costly. This is a costly process if you have no kind of harmonized reporting. At the same time, the smaller insurance companies, they don't have the resources to, let's say, develop their own standards. So I think we've done quite a lot in terms of risk management. We're not there yet. I would be very much in favor, indeed, of, and that process is ongoing, that also in the regulatory supervisory standards, we come to some degree of harmonization. And I think the IAIS papers that were written or produced together with the CIF are a very good first step in that direction, but I think we should go beyond that. And now the next step is also to look at reporting requirements, disclosure. We're quite happy that also there's now an IFRS consultation ongoing. I think this is also where the place where it should be, because we're not only talking about information or disclosure from financial institutions, but also non-financial institutions, because very often, the insurance companies need that kind of information if they are a major investor, and also to manage their risks. I would, however, let's say, I think it's important also to tell our colleagues working in that particular area that there's really a sense of urgency, and speed is of the essence here. And let's say on some IFRS, it took years and years and years and years before we had anything. And I think we really need to have something quick here. And I think there's already a lot out there, which let's say the reporting experts can use. I also know that indeed Mark Carney, we all know him. He's now the special UN envoy, working towards the COP in Glasgow next year, and I think it's also one of his major issues, the not only reporting but also the harmonization of reporting requirements.
So, in summary, you think there is both urgency and a degree of inevitability about convergence towards a global standard. The question is just who would that come from, and and when would it occur?
That's a nice summary of my intervention, which might be too long. Thank you.
Aylin, back to you. So, what has been impressive in recent years is that there is a lot of initiatives going on at firm level. Industry groups have come together in many jurisdictions to develop modeling standards, climate measurement. There's whether they be sort of industry associations or groups of like-minded firms. I know Allianz has been involved in leading some of that effort. How do you view the firm-led, industry-led versus standard setter? How should all this come together so that we can have appropriate, comparable, market-rated disclosures firm by firm?
Thank you very much. I really concur with what Olaf said in terms of a sense of urgency, the need for standardization, but also kind of keeping going. And I think the answer to your question is a little bit of a combination of both, because of all three. There are external challenges we are facing with the data quality, availability, especially on value chain emissions, exposure to physical risks. We have developmental challenges on the climate change risk models, and commercial tools are still a bit intransparent. So I think from one perspective, in terms of if we have an international standardization of non-financial reporting with a high degree of comparability, and here obviously you have to take into consideration the resources that the smaller insurance companies can put into play, and I think that common denominator needs to be found, and this could very well be done under the umbrella of the IFRS Foundation, for example. But we do still face some kind of a misalignment of disclosure requirements also at the European level. And we also have some timeline mismatches across the different legislations. And I think to mitigate the compliance and liability risks, it would be really good, and I think as the industry we're striving for, is to have a phased-in approach of requirements in combination with reasonable best effort solution. I think that would be a really kind of reasonable way to go about it. And still, we have internal challenges in terms of, our own, although we are a very big insurance company, we still have challenges in terms of how the OEs do their reporting with the different local requirements. But what we do is, in order to ensure consistency, we have a board mandate and approach, clear level of responsibilities, using the industry-specific guidelines, and we realize it's a journey. We are very ambitious, but it's a journey with progress over time, and we start with the tools we are confident with, and then we don't simply buy, just third-party products, but we be open about the challenges to look at longer-term solution avenues and really engage on improving data quality. I think if we're able to improve data quality, it will be much easier to set really the data standards as well.
So as a publicly listed company, you're dealing with investors all the time, and those investors are speaking to the equivalent of a growing band of climate like ratings agencies who are rating performance of different firms. How, when you're out in the market talking to investors, how do you find the quality of that information that comes from those climate of measurement or taxonomy at this point?
Geoff, you got cut off you got cut off the last 10 seconds. Did Geoff cut off or?
Yes.
Okay.
Can you hear me now?
Yes, Geoff, I can hear you now. I think you were asking a little bit about how do we find the data quality and what our investors are kind of questioning, right?
Right.
Maybe I can talk a little bit about that. Basically, it's certainly, we do find publicly available data. It's not that it's not available at all, but and we are seeing, some, we are making use of all the aligned matrix and taxonomy in terms of GHG emissions, split by scope categories. We can really look into measure, how we are reducing our own carbon footprint. Obviously, this is not the only thing. The Dow Jones Index, for example, is extremely comprehensive. So there are you can quantify much more. I think the carbon emission related data you can also quantify, especially within our investment portfolio, and that's what we are focusing on also with the Asset Owner Alliance. What we can do within our investor portfolio on the asset side of the balance sheet. So, for example, the Asset Owner Alliance has developed principle for an ideal methodology. The members are willing to develop approaches. I think this part will become stronger and stronger. I think in terms of governance, we do have good examples, and I would count ourselves as one of those examples. But I think, as I said, the governance needs to evolve in terms of impact. And, climate risk cannot be seen in its vacuum. It has huge confluence effect on all the other risks that we kind of live and breathe. Liquidity risk, market risk, the reputation risk, both non-financial and financial side. So as its impact is more quantified, I think we'll be able to see these links and be able to also report on this. And this will impact the governance as well. So it's a little bit of a virtuous cycle, I hope, in terms of really creating the impact. And that's what matters in the end.
So thank you, Aylin. On those interrelated risks, Olaf, I know that the DNB has been looking at biodiversity, and we have also been talking about that at the Sustainable Insurance Forum. How do you see disclosure of other nature-based risks in this I guess continuum of disclosure and risk maturity?
Yeah, thank you, Geoff. First of all, I think it's very good that indeed the Sustainable Insurance Forum has decided to. I read the the release, the information that you send out on looking at biodiversity. First of all, I think it's good because we had this discussion also when we started to think about climate risk, and I'm pretty sure a lot of people ask themselves the question, what is this biodiversity? What are these regulators, supervisors, central banks doing? The point is that all these kinds of risks can be translated into financial risks. And I think that's exactly the point. So, and then it becomes, let's say, a real risk also for, indeed, risk managers. How does it work with biodiversity or the loss of biodiversity? If measures would be taken, first of all, if measures would be taken, and there's a huge summit, but there's a summit next year in China to discuss biodiversity and standards for biodiversity. If measures would be taken that kind of firms, and not only talking about insurance firms, but also other firms, kind of force to take measures to, let's say, do something regarding their exposure towards risking biodiversity, it will harm the value of that company, or it will harm the business model of that company. So if you are an insurance company and if you have exposure to that kind of company, you run a risk. It's the same like when you are heavily invested in, let's say, fossil fuels. So there's an analogy which you can draw. And I think this is exactly what we try to do. We published a report called Indebted to Nature, first of all, which tries to outline what are exactly those risks, or tries to translate loss of biodiversity into financial risks for banks, insurance companies, and pension funds, and then tries to come up with an estimate first estimate of at least how large the risk might be. And indeed, what we have asked financial institutions in the Netherlands is, next to climate risk, it is something that is so material, please put it on your list of at least risks that you should look at when you're doing your risk assessment. And actually also in the Netherlands, financial institutions have taken that up, and they have together said, indeed, this is something we really want to take seriously. And I think, yeah, you are very, very well into this topic as well. It's always important to explain that we're not doing this with, let's say, political agenda or whatever. That's not our aim, and that's also not our role. But we try to translate certain risks that we see into which appear to be non-financial in, let's say, balance sheet risks, and they are real, and they can sometimes be quite big.
I mean, there is a question to that very subject that's come through from the audience about, shouldn't regulators be sticking to, in our case, insurance risk, and why are we looking at these risks? So I guess your answer to that would be, it actually does flow through to mandates. I know that's been the case with the NGFS, which is on the banking side as well, and central banks. Do you want to just make some brief comments about that challenge about how do these issues relate to an insurance regulator's responsibility?
Indeed, I understand the question, by the way, but indeed, as I said, those risks have economic consequences. And I think just like we are now in the middle of a pandemic, it's not a financial risk. It's a medical emergency, but it has clearly economic and financial consequences. This is the same. Climate risk is also, it's not a financial risk as such, but it might happen. Actually, it is already happening. And it is going to have, in one way or the other, economic consequences. It's going to have consequences for financial stability. And one way or the other, either because governments are taking measures to avoid the increase in let's say, the average temperature, or because they fail to do so, or they're not able to do it sufficiently. And then we will see, changes in weather, flooding, etc., etc. And this is exactly, I think, also where insurance companies come in, both on the liability side as on the asset side. So these are things you have to take into account when you're managing your risks. And very often we have said, it's long term, and why should we care about something that's going to happen in the future, in the far future? As I said, and if you look at the evidence, I'm not so sure whether it's that long term. It's already happening now. If you look at weather events, if you look at the valuation issues, when we talk about stranded assets, it's already happening out now, and maybe much faster than we even thought a couple of years ago. So I think it's at the heart of our mandate.
Thank you. Ray, a question that's come through dealing with skills of supervisors. Aylin has spoken at some length about the efforts that Allianz has been doing to improve their capability. How as supervisors do we respond to the expertise in this, what is a new emerged accelerating risk, which is challenging not only firms but challenging capability within insurance supervisory agencies? How is the NAIC thinking about skilling up its members?
It's a great question. Let me follow up on what Olaf said. I think the risk is here. All you have to do is kind of look in this country where we have more flooding, sea levels rising. We have some of our towns in the coastal areas that when it's cloudy, it looks like it's flooding. So the risk is here today. This is certainly a long-term risk, but it's certainly a current risk as well. So the NAIC continues its educational efforts. We have ongoing for each state, each regulator, a continuing educational program. We have once a year, we have what we call an insurance summit, where we look at several different, a number of different categories and issues, and drill down and continue our educational process. We also, as regulators, we require our employees, our regulators to continue their education, continue to get designations, to keep current with not only these risks but others as well. So it's a continuing process, just like it is for the industry.
Thank you, Ray. We're getting close to time, and I want to just finish with a question, perhaps for each of you, which I'll cycle through. I see we've got about 5 minutes left, so if you can keep that in mind with your response. But Ray, I'll stay with you and ask you first. Again, a cheeky question, but there's an incoming new administration in your country. Those that are interested in the climate debate have watched US politics very closely, because there has been quite a difference of views. How do you see that influencing your work and insurance firms, the new administration?
Well, in two areas. Before we get to the new administration, the NAIC itself has been studying the impact of climate risk for a number of years. And so we've established this executive level task force that I mentioned earlier. That's going to be the vehicle for all climate related decisions going forward over all of our different committees. That task force has 5 different work streams, from solvency to climate risk disclosures to pre-disaster mitigation and innovation and technology. And so that work is kicking off and progressing. But, you know, we certainly strive to ensure we're at the forefront of the thought leadership and action on this critical issue. At the federal level, President-elect Biden recently appointed Secretary of State John Kerry as his special envoy for climate, underscoring the importance of the new administration will likely place on this issue. Also, with regard to federal regulatory environments, last month in its semi-annual report on financial stability, the Federal Reserve for the first time highlighted climate risk as a potential risk to the stability of the financial system and said it's working to better understand that risk.
Yeah, they're all significant developments, and I'm sure they'll have an impact on your work. So thank you for that. Olaf, 2021 is a COP year. Europe has been at the vanguard of a lot of this work on climate risk. What do you think of the expectations around COP26 in Glasgow in November 21? How do you see next year playing out in terms of the development of things like standards, guidance, the general alignment globally on climate-related risks?
Yeah. No, I think it's going to be a very important meeting, and I'm also quite optimistic. First of all, just listen to what Ray was saying. Everything he's been saying was like music in my ears today. So he made my day when it comes to this topic. But also, as we know, it's not only in the US but also in other parts of the world. Things are moving in this direction, or in the right direction. And so I have high hopes, but I think it's also necessary that we take let's say subsequent steps, in particular, indeed, in the area of reporting, we need to take the next steps for sure. And again, it's not because that's fine, but this is on another plate. It has nothing to do with politics or whatever. It's just looking at facts. And what do they mean for the financial industry and for economics? And that's our job as regulators, as central banks, but also indeed as members, as financial institutions. I think there's really a big problem out there.
Thank you, Olaf. And Aylin, last word for you. Allianz has certainly been you're leading in many areas. Your group CEO, Oliver Beatty, has been at the forefront of this. Where from a corporate sense, does Allianz want to be in, say, 24 months' time?
We have a pretty clear net investment portfolio commitment. So we have committed to decarbonize our proprietary investment portfolio to a net zero emissions by 2050. We have also, together within the UN Convention, the Asset Owner Alliance. We have started as 30 members now, more than 5 trillion of assets. So, and in Q1, this is in 2021, we will announce our 5-year targets. So I think from all overall, we have a shorter term in the 5-year targets is basically 25% reduction in our emissions. And in the meantime, in the next 24 months, we will continue to work on expanding our scenario analysis, really improve our societal impact and really move from leading to really hopefully shaping these discussions. That would be our ambition.
Well, thank you very much, Aylin. Thank you, Olaf, and thank you, Ray. I thought that was a great discussion. Before we close out, can I just again remind you about the application paper that has been released for public consultation. We certainly would welcome input from everybody on this call. It's open for consultation till January next year. A great effort by the Sustainable Insurance Forum and the Global Standard Setting Body for Insurance, the IAIS, and we would welcome your input in helping to shape that paper. But for now, that's all of us, all from us. So again, thank you to Aylin, Olaf, and Ray, and it was a great pleasure to host this panel. Thanks, everyone.
Thank you, Geoff. Thank you very much.
Thank you, Geoff.
Thank you very much, Geoff, and thank you, Ray, Olaf, Aylin. It was an excellent panel on an issue that's really at the core of the IAIS's work. We've spent a lot of time over the last couple of years looking at it, and in no small part that's been due to Geoff's leadership. I want to thank Geoff again for moderating this panel, but also for the commitment and the energy that he's put into the topic over the last few years. Unfortunately, his meeting on Wednesday was the last EXCO meeting for him. But I know that the leadership he's shown on this issue, the work that he's done, and the commitment that he's made is going to far outlast his contributions to the IAIS over the last couple of years.